Let us start with the contradiction. Oil prices are under pressure. Canadian energy stocks are navigating a complicated macro backdrop. Tariff uncertainty, OPEC supply dynamics, and a softening global demand outlook are all crowding the headlines. And yet, Suncor Energy just set a new 52-week high. Short interest in the stock has dropped significantly, and the analyst consensus has settled at a moderate buy. That is not the behavior of a company in distress. That is the behavior of a company that has structurally repositioned itself in a way that the broader market is only beginning to price in. So the core message of this video is not that Suncor had a good week. The core message is this: Suncor may be the clearest example in the Canadian energy sector of a company whose business model is becoming more defensible precisely when commodity volatility is at its highest. And if that thesis is right, the recent price action is not a ceiling, it is a floor being established. Let us compress the week's events quickly and move on to what actually matters. Suncor drew sustained coverage across financial media, with particular attention to its positioning within the TSX 60 index. Share trends captured growing attention on Calkine media across multiple reports. MarketBeat flagged the new 52-week high. Defense World noted the moderate buy consensus from brokerages, and MarketBeat separately reported a significant drop in short interest. Taken individually, these are data points. Taken together, they form a pattern, and that pattern deserves serious analysis. Now, here's the structural argument for why Suncor behaves differently from a pure-play crude producer. Suncor is integrated. That word, integrated, gets used so often in energy sector coverage that it has almost lost meaning. But let us be precise about what it actually means in Suncor's case. Suncor does not just extract oil from the oil sands, it refines that oil. It sells the refined products through its retail network. That means when crude prices fall, Suncor's upstream margins compress, yes, but its downstream refining margins can actually expand because the input cost for its refineries just got cheaper. This is not a perfect hedge, but it is a meaningful structural buffer that pure upstream producers simply do not have. This integrated model is also why Suncor's position within the TSX 60 is not just a benchmark footnote. The TSX 60 reflects large-cap Canadian equities with institutional ownership, liquidity, and index tracking demand. When Suncor's weight or positioning within that index draws attention, it signals that institutional flows, not just retail sentiment, are moving, and institutional flows tend to be more durable than sentiment-driven trades. Now, here's the point most people are missing, and this is where the analysis needs to go deeper than the headlines. The significant drop in short interest is being reported as a bullish signal, and in the immediate term, it is. When short sellers cover their positions, that is buying pressure. It contributes to the price move toward the 52-week high. But here's the less obvious read. A large reduction in short interest also means the stock has lost a key source of potential future buying pressure. Short covering is a one-time event. Once the shorts are out, that fuel is gone. The question becomes whether fundamental buyers, long-term institutional holders, dividend-focused investors, index rebalancers, are prepared to sustain the price at these levels without the short covering tailwind. This matters because Suncor's oil sands operations carry a specific cost structure that is very different from conventional oil production. Oil sands extraction has high upfront capital costs, but relatively low marginal production costs once the infrastructure is in place. That means Suncor can keep producing even when oil prices are lower than a conventional producer could tolerate. It also means the stock's valuation is more sensitive to long-run oil price assumptions than to the near-term spot price. So if the market is pricing Suncor as though oil prices will mean revert higher over a multi-year horizon, the 52-week high makes sense. If the market is simply reacting to short-term momentum and covering, then the 52-week high is fragile. That distinction, structural re-rating versus momentum-driven squeeze, is the analytical question that separates a genuine investment thesis from a trade that has already been made. So let us run the two scenarios clearly and honestly. In the first scenario, the constructive case, oil prices stabilize or recover modestly over the next 12 to 18 months as OPEC maintains discipline and demand from Asia holds. In this environment, Suncor's integrated model delivers exactly what it promises. Upstream margins recover, downstream continues to buffer volatility, and the moderate buy consensus from brokerages proves conservative. The institutional attention reflected in the TSX 60 coverage translates into durable ownership. The 52-week high becomes a base, not a top. Dividend sustainability, which has been a core part of Suncor's investor narrative, remains intact, and the drop in short interest reflects genuine fundamental reassessment, not just tactical covering. In this scenario, the current price action is the beginning of a re-rating, not the end of a trade. In the second scenario, the stress case, Oil prices faced sustained downward pressure, driven by weaker global growth, higher than expected supply from non-OPEC producers, or a deterioration in the Canadian macro environment amplified by trade policy uncertainty. In this environment, Suncor's integrated model buffers the first leg of the decline but does not eliminate it. The high fixed cost base of oil sands operations means that if oil prices fall far enough, the production economics get challenged at the margin. The stock, having just hit a 52-week high with short sellers already out of the way, has fewer natural buyers stepping in on weakness. The moderate buy consensus could shift, and the TSX 60 attention, which drove institutional interest on the way up, could also drive systematic selling if the stock underperforms the index. The honest read is that both scenarios are plausible right now. The macro environment is genuinely uncertain. What tilts the probability weighting toward the constructive case is precisely the structural argument, the integrated model, the low marginal production cost of oil sands, and the institutional positioning within a major Canadian index. These are not temporary factors. They are embedded in Suncor's business design. What tilts toward the stress race is the timing of the 52-week high. Stocks that reach new highs in the middle of macro uncertainty are either leading indicators, they see something the data has not confirmed yet, or they are momentum artifacts waiting for a catalyst to correct. Distinguishing between the two requires watching the next earnings cycle closely, monitoring oil price direction over the coming months, and tracking whether institutional ownership in the TSX 60 context deepens or rotates out. The bottom line is this: Suncor is not a simple bet on oil going up. It is a structural play on a business model that was built to survive commodity volatility, and the evidence from this week suggests the market is beginning to reward that design. Whether the reward is durable or premature is the question still being answered.